Okay. Good afternoon, everyone. Good afternoon. Please, as you're entering the room, make sure that your name is on your Zoom window and make sure that you are muted at this time. And we are going to begin shortly. Okay. As everybody's getting in, I would like to welcome you all and introduce myself. My name is Alexis Fox, and I'm the Marketing and Training Manager here for the South Florida SBDC at FIU Business. And today we are doing a webinar partnered with Miami Made on how to make your business bankable.
Excellent.
Yes, awesome stuff, Alexis. Thank you so much. Great to be here.
No problem. So before we get started and I introduce not only your facilitator for today, Mr. Ray, and also our partner, Joe, I do want to alert you all to please subscribe to our newsletter. It is the best way to learn about more of these opportunities. It's the best way for you to stay connected to resources and to stay connected to what's going on with our partners, such as Miami Made. So please take a moment to either scan the QR code or to use the link in the chat. We would also ask that you follow us on social media and share this information with your networks. It's really important to us to know that you all are not only enjoying the content, but also taking the opportunity to let your constituency know that you are doing things to better your business. So please follow us on social media. You can scan the QR code, and there will also be a link in the chat to do that. And now, without further ado, I would like to give the floor to our partner for today, Joe Metcalf with Miami Made.
Thank you so much, Alexis. Great to be here. Thank you, Small Business Development Center at FIU. We're excited to be partnering with you today. We had you as a sponsor last year for one of our live events, and it was fantastic. Lorna came into one of our meetings and shared more about the SBDC. So grateful to have this partnership with you, and great to see some familiar names on the call here and members of Miami Made. And thank you for being on here, and nice to meet all of you from the SBDC that came from your side. So just a little bit about Miami Made. We are a community of entrepreneurs, founders, and business owners who come together to support each other, come together to help each other thrive on a deeper level, right? We care a lot about our growth, not just professionally, but personally, right? I feel that Miami Made is a space for entrepreneurs to remember their sense of deeper human connection, right? And it's through that human connection where we get to create opportunities and find ways to create opportunities to succeed in business, right? So we meet on the first Tuesday of every month. It's called Thrive Together Tuesday, and it's at 7:30 a.m. till about 10 a.m. The first Tuesday of every month. So the next one's coming up on March 4th. We're going to have a link in the chat if you want to learn more about our live events and attend on March 4th. So I'm super excited about that. We have a great speaker on March 4th speaking on AI and how to leverage AI for your business. So March 4th, 7:30 a.m. to 10 a.m., Thrive Together Tuesday. So really excited for today's call, Alexis. Great, excited to hear Ray speak on how to make your business bankable, and yeah, will be a lot of fun. So thank you so much.
Excellent.
Thank you so much, Joe. And as we mentioned, the link for this March 4th event will be in the chat. It will also be available to you in the email that will follow this presentation. So you will have access to my contact information, the team at SBDC, Ray's contact information, and Joe's contact information. So please make sure that you're utilizing that. And if you are not subscribed to the e-blast, please take the opportunity to do so. Okay, great. And as we get started here,
Go.
I'm going to go ahead and give you all a little bit of information about the SBDC, and then we will turn it over to Ray. So Ray is a consultant with the SBDC here and program manager at FIU, and he specializes in access to capital, which is what he'll be discussing with you all today, for small and medium-sized businesses in the South Florida area, and currently the lead on the Florida SBDC Access to Capital Task Force at the state level, a committee member at the national level, and he has a very extensive experience in the banking arena where he spent over 4 decades of his career. And as a banker, he has generated close to $1 billion in loans in a diversified spectrum of loan types and held many senior management positions. So this is someone who's very well versed in loan opportunities and investment opportunities. He held many senior management positions and traveled all throughout Latin America and the Caribbean basin. He also is a college adjunct professor, corporate trainer, and he has taught many banking and financing courses since 1985, along with many different training and guest speaking engagements, such as the one that we're doing today on behalf of the SBDC and FIU. So this combination of senior exec positioning, as well as just a seasoned academic and a passion for teaching, if I do say so myself, it allows him to provide a conceptual as well as real life experience in the field of finance. And you all are really in for a great treat today from Ray.
Well, God bless you for that. What a beautiful introduction. Oh my goodness. Huh? All I can say is add to that, and the guy is old. The guy's old. So many
No,
years. Been dating
he's
myself.
great. He's great.
He's
And
got
he's been
seven grandchildren. He's got seven grandchildren. But it's
he's been a
okay. It's
great
okay.
asset to us at the SBDC here. And here's some information on the SBDC here at FIU. We've done over 120,000 hours of consulting. We've helped almost 10,000 entrepreneurs, 500 businesses launched, 475 million in capital access, which Ray is a part of that number as well. 314 million in government contracts secured and 471 million in increased revenues. We are one-on-one business consulting, which means that if you are interested in consulting with Ray outside of this workshop, you will have the ability to do so. You simply need to register with the SBDC and a link will be provided for you to do so. And with that,
Awesome.
I'm going to turn it over to Ray to
And
go ahead.
Alexis, can I just jump in real quick? I just want to give you guys a testimonial with the SBDC because I know a few of our members have used the services. And just to say, guys, this is government funded, so it's 100% free consulting, right? So it's a great resource for business owners. It's a great resource for entrepreneurs to tap into guys like Ray that are providing consulting for small businesses, consulting for entrepreneurs, and there's one in particular case where a member, she has a startup and she's been getting all sorts of support from the SBDC on how to get funding and how to get government grants. So she's got great feedback about the SBDC right in our community. So we're definitely in for a treat today. I just wanted to give that shout out and thank you again, Ray. Thank you again, Alexis.
Yeah, that's that. Thank you. Well, thank you. Hello to everyone. Good afternoon. And it's a pleasure to be here. And this is definitely probably one of my favorite presentations to be involved in, simply because at the end of the day, everything that we do at the center, whether it be assisting you with business planning, branding and marketing, website design, etc., everything is just to make you to get to the point of where now you're positioned to be bankable. The idea is that for a business to progress, it needs like a car. It needs gasoline to fuel the engine, right? And that gasoline for small businesses is access to capital. So learning, because today, we offer many different courses that I have had the pleasure of putting together, from analyzing financial statements to cash flow, managing your cash flow, budgeting and projections, and other courses that I really truly enjoy doing. Something that I've done for so many years. The idea of today's presentation is kind of to give you, let's say, the bird's eye view of a lender. What let's just say you're looking through the eyes of a lender. What is it exactly that you need to really be bankable. And that's why, that's the title of this presentation, is really how to be bankable. So the idea today is to give you, information that will assist you to better understand what is it that you're looking for. Because sometimes we get approached by clients, and I mean, I do this, day in and day out. And the last year, to give you, just give myself a, a plug. I mean, last year I did over 16 million in access to capital impacts, and they were mostly SBA loans. So we were able to assist lenders, and so I'm hoping in the next year that maybe my milestone will be like 100 million in impact. So we're busy. We're busy here trying to help you guys out. But what we try to do is make you realize where you're at the moment, because sometimes you're not ready, because you need to do certain, let's say, remedial actions to the business to get you to that bankable state, and that's what we do. You want to be represented in the best possible way, and then in doing so, you need to understand exactly what it is that lenders are looking for. Jose, we can move to the next slide for me, guys. We got my Lauren, are you there? There you go. So begin understanding how lenders evaluate borrowers. Let's get to the next slide. Okay. This platform, the 5 C's of credit. This is like universal for all lenders. This is what all lenders use. I don't care if you are a traditional bank, if you're a credit union, even some of the non-traditional lenders, you need to use this base, which is called the 5 C's of credit. Okay. Then what we're gonna do today, we're gonna let's say, like I call it, we're gonna peel the onion today, right? We're gonna go through each one of these C's and explain to you what they represent, and again reiterate that this is the platform that's being used. This is like like a part of a Bible for the lender, the 5 C's of credit. Okay, next slide. Okay, so they all remember. So all lenders use these 5 C's because remember, lenders approach things in two ways, right? The qualitative, about the business, what it's all about what you're doing and stuff, and quantitative is more about the numbers, right? Because at the end of the day, you need to learn to speak the financial language, right? Which is the banker's language. And what they'll do is, and we'll understand through this presentation, what it is that happens during this quantitative state of the analysis of your business. And let me tell you, I always say this in all my presentations. You, as small businesses, you need to learn to embrace the numbers. Okay, there are many businesses that are out there, and they're so tied up in the day to day, and they're not spending this critical time to kind of do some strategic thinking about understanding better your numbers, your margins, your break even, and you need to understand that to be able to better represent your company when you approach a bank to request a loan. Next slide, please. Okay. So what do? We're looking at the overall strength of the borrower through qualitative and quantitative. Next slide. Next slide. So the first one is character, right? And when we talk about character, it isn't that Joe's a super nice guy. He's got a great smile and nice looking beard. No, or he can cut some really good jokes for you. It's really about his experience, his background experience, and his demonstrated management of his credit, which we see through. And that's good. Go ahead. You can move on to the next one too, the credit score, because that's really what character in the 5 C's is all about. It's about your background experience as well as your credit history, right? Which are your FICO scores. So, I certainly hope that all of you that are present today in this webinar, that I hope that you are always checking up on your FICO scores, because credit is important. And let me tell you, it's not written in blood. It changes. It's a moving target. One quick way to improve your FICO score is always to lower the balances, the utilization on revolving credits. That pretty much automatically helps your FICO scores to increase. You need to have good FICO scores, and we'll talk more deeply about that. What construes a good score, but I mean, this is what the first C is: character. It's about your background, meaning that you have experience. For example, if you approach a bank and you want to buy, let's say, a business, or let's say a franchise, and you know absolutely nothing about that business, that is considered by the lenders a risky venture, because you really don't have the experience regarding the business that you're proposing to acquire. So this is important to understand that. Okay, let's move to the next slide. Anyone there? Okay. So when you hear about FICO, this is what it stands for. It's made up of 35% of the score is made up of payment history, 30% amount owed. That's why I told you, if you pay on time and you keep, let's say, your balance is generally running at 30% utilization, then your score is going to be relatively good. Okay. Then you have length of history, 15%, then new credit, 10%, and types of credit. Not all credits are created equal now. Because remember, if you have a term loan, you know that it's principal and interest. It's one disbursement, so you can't use it again. So the lender knows that all it's going to do is going to continue to amortize till it's over and paid for. Revolving credits, today you can have zero balances, tomorrow you can be up to your eyes and ears in utilization, right? So that's why it's important to understand. Or just like so an installment credit is, it's a lot easier on the eyes for the lender, because they know they can predict. It's much more predictable, right? If you have a lot of revolving credit, one day you could be low and the next day you could be high. All right, next slide. And these are the different bureaus. When you look at this: Equifax, Experian, and TransUnion. What I've learned throughout the many years in this business, that some of them have, let's say, they're more efficient. For example, Equifax is more up to date, more efficient on the East Coast. Experian is in the middle ground, although they've gotten much better. And then TransUnion, they're more servicing like the West Coast, right? So that's why sometimes you see these differences in FICO scores, because the information is not reported as on a more timely basis. So that's why you'll see changes. And then when you approach a bank, typically what they'll do is they'll drop the highest and the lowest, right? And basically they'll go for the middle ground. Okay, next slide. Yeah, how about business credit? It's available. Yes, there are some business credits, uh, you know, but what happens is that lenders, to answer your question more directly, yes, there is some business credit that comes out. You have Dun and Bradstreet, then you have others, but the lenders will always look at what's called universal income, right? So they'll always take into consideration what your personal FICO scores are. Okay, so all right, so where are you on the credit spectrum? Uh, does everyone know? Does everyone know? And Lauren, when you get a chance, look at any issues on the chat that I can address, I'd be more than happy to. But I mean, again, universal income is what lenders always look at. That means they'll look at your personal as well as your business. I'll give you an example. You can be someone that has a couple of businesses and they're doing very well, right? But let's say all of a sudden you've gone kind of crazy, la vida loca, and you're out there spending money left and right on a personal level. So what ultimately happens, then your personal score will drop, and you may be hit with some derogatory stuff, and then it may start impacting your businesses. So they see that as a risk. So that's why lenders will look at both, business as well as personal. Okay, next slide, please. Okay. Now, it's always also good to mention, and a lot of people don't know this. A lot of banks have their own, they'll still use the FICO scores, but what they do also is they'll have their own internal score. That's usually impacted by what? If you're a client that has a depository relationship or other services that you're using, this obviously will help you when they look at your overall situation, right? But they always keep that. The other issue is that, they may look at some businesses a little bit more aggressively or less aggressively than others based on their credit exposure to these. So all these are factors that they look at. But the basic fundamental is that you need to, watch your credit score. You can do it easily through FICO. You can either do it, there's some free services like Credit Karma, Credit Sesame, but then you have, Equifax, Experian, and they have, services that you constantly be viewing your credit. Next slide. So again, like I mentioned, credit is really, it's a moving target. I mean, your FICO scores are not written in blood. It's not like now you're gonna just, roll in a little ball and die. No. Basically you can, prove that simply like, and one of the ways of doing is, as I mentioned, is, focus on reducing the utilization, right? Obviously derogatory information, you need to address that. And you need to resolve that. But the quickest way to improve your FICO scores is to reduce utilization. Okay, let's go to the next slide. And this is just like an example of a spectrum of on credit. Quite frankly, when it comes to a business, if you hit 680, that is good enough for the bank. Okay. 680 is usually like the entry point. If you've got a FICO score lower than that, they're going to be maybe demanding collateral. If it's an asset-based lender, obviously they may be leaning more to the value of the actual asset involved and stuff. But let's say a good entry level is always being at 680 or above. Okay, next slide. Okay, so the first C was character. We know that uh, character is about the background, your information, the experience, and then your credit. Capacity is the quantitative C, right? This is where we try to make a determination, your capability to repay the loan, okay? And that is cash flow, right? Because remember, you can have a business that you reported I've had clients like that where they tell me, Ray, listen, I don't understand. I paid my taxes, I reported net income, and when I go to my bank account, I don't have much in the bank account. I said, well, more than likely you're probably selling too much on credit or you're investing too much on inventory or both, right? And that what that tends to do is dry up your liquidity. When you dry up your liquidity too much, then in the eyes of a bank or a lender, it becomes a problem. So capacity is about your ability to repay, and the bank will go through certain levels of analysis. In fact, I'm planning on doing a presentation on one particular tool that's called common sizing statements. I would like to share that with them, Joe. Maybe at another time we can talk to Alexis about it. but that's one presentation to make people understand how to be able to read your where you headed, because you could be making money from one year to the other, but then you don't realize that your margins are deteriorating. So doing common sizing statement is going to help you understand better where you're at. We'll understand more about your business from a financial perspective. Okay, the next slide. So when you look at, like I mentioned earlier, capacity, the evaluation of it in this quantitative process, it's about this universal cash flow, right? Which includes both the personal and the company. All right. They want to see both because they want to be able to mitigate the risk more precisely. Okay. And this is the way to do it. Make sure that they understand, all revenues and expenses, and what can somehow in the future impact in a negative way your capability in repaying the loan. Next slide. So what are the key areas that we look at from a quantitative perspective? Okay. In the whole credit analysis process, we look at what? Liquidity. Okay. If you have sufficient liquidity in the business, your level of indebtedness. Do you have too much debt? If you're too leveraged, which is the same as saying that you have too much debt, right? Then obviously it's a risk. If it's a company, when you look at the balance sheet and you see that it's got a very low level of capital, it becomes a riskier company because any hiccups can obviously fold the company. Profitability, is anybody here in the business of not making a profit? I certainly. I mean, Joe, are you in the business to make a profit? Huh?
Absolutely. Let's go.
Okay, all right. So profitability is definitely another area that's looked at. And one area that I love to focus on, and again, this is an area where there's tremendous opportunity to do more trainings, it's what I call operational efficiency, which is really about what? About the cash conversion cycle. Being able to manage the situation where you have a company, you have a product that you sell, you have to buy the product, then you sell the product. How do you sell the product? First of all, how do you buy it? Do you finance it? Do you pay cash? Do you get trade credits? Then you sell the product. You sell it on credit. What are the terms? Because the conflict between how you buy the product and the time it takes you to get paid is where you create financial gaps, right? And this is where people need, some financing support. So if you're able to manage that process more efficiently, then obviously your profitability is going to increase. For example, if if we were in the buy and flip kind of business in real estate, and we only had $500,000 to invest in real estate, right? And let's say you've got your team set up or whatever. By the way, trust me, if you're ever going to do that business, you got to make sure that you have the right team in terms of repairs, because those repair guys can bring you to death, basically, because they'll eat up all your profit. But I mean, if I have $500,000 and I've calculated all my planning that I'm gonna every time I unload the property, I'm gonna make net 5%. If I do this 4 times a year with that same money, that's 20%. But if my turn is only gonna be once, it's gonna be 5%, right? All right. So the more efficient that you are in that turnaround time, the better you manage and optimize your cash conversion cycle. It's going to make you a much more profitable company, and it's going to reflect very positively on you and the company in the eyes of the bank. Next slide. So liquidity, some definitions: ability to meet short-term obligations with short-term assets. Remember, assets is what you own, liabilities is what you owe, right? Okay. and equity is the difference, your skin in the game. Next slide. Okay. Solvency, level of indebtedness and financial, and how do you manage that debt? If you have a lot of debt, it makes it more difficult, right? For example, if you have a lot of debt and you approach a bank and you want a loan, a new loan, the way they're going to kind of calculate your debt service coverage, which is basically net operating income over principal and interest payments on existing debt and new debt, that has to be at 125, the result of that equation, at 1.25. If it's lower than that, it's because I call that debt service coverage your ticket to admission, basically. If you don't hit the 125, even though let's say SBA can go as low as 115, if you're not in that vicinity, then things become much more difficult for you. Okay. Remember how banks, when they go through this quantitative process, it pretty run down like a checklist on these things, and you need to understand what it is that they're looking for. Next slide. So there it is, understanding that by the way, this presentation, Joe, and you and all of the participants, you can have access to this presentation when we're done, okay? It'll be available to you. And as well as obviously my number, if you guys need any help by registering with the center. So the bank uses the debt service coverage as a way to weed out undesirable loans. For example, like I say, 125 is acceptable. Anything under that, it becomes a problem. Next slide. Okay, that's good. No, that's good. So this is an example of debt coverage, right? All right, you got operating income. It's divided by total debt services and cost, and that measures your ability to service the debt. Okay, next slide. And here's an example of someone who didn't quite hit the mark, right? But see, that's how this is calculated. And please always remember, I always tell everyone, listen, I'll give you $100, Joe. I'll give you $100
Okay.
if you can confirm to me that you write a check for depreciation expense for your business.
Okay.
But I doubt that you'll do that.
Yeah, I don't. Yeah.
Of course not, right? Because we know depreciation is a non-cash item, right? And that's why depreciation is added back into your cash flow. Okay, you need to understand that. So there are a lot of businesses out there that have an incredible amount of depreciation expense that is added back to really because let's say depreciation, you don't write a check, so that money's still in your pocket. So it's important to understand that, right? Next slide. Okay. So profitability, wow, this is what we're all trying to do, right? Reflects a company's success in generating profits. Next slide. So what are the typical challenges? Again, this is why we do the presentations that we do. Lack of knowledge regarding operating margins and profitability, not understanding how to do a break-even analysis, poor management of working capital cycle, the one I mentioned earlier, this cash conversion. The better you manage that, the more profitable you're going to be. Next slide. Okay. No, go back. Could you go back? Not understanding the three key financial statements. Balance sheet. What's on the balance sheet? Assets, liabilities, and capital, right? Or owner's equity, right? So balance sheet tells me what I own as a business, what I owe, and the what's left over, the value, the net worth of the business, right? Now, profit and loss, everyone understands that one, right? Revenue less expenses, and I hope I have my net income, right? And then the cash flow statement is perhaps one that a lot of small business owners may not understand. And quite frankly, it was really introduced in the mid to late 80s. And what it does, it tells us where are the inflows and outflows of cash in the business? What's happening in operating activities, what's happening in finance activities, and what's happening in investment activities. So that, for example, if I have a company, I have two companies, they both reflect they both reflect 5 million in cash, right? But if one got the 5 million from operating activities and the other one from a loan, they're not the same, right? Because that company with 5 million cash sitting in the account actually owes $5 million, right? You see? So that's why important that this flow fund statement really tells a third party, when they look at these, they realize where the inflows and outflows are of cash in the business. Okay. Next slide. And this is again the efficiency of the business. Again, I let me ask you, Joe. It's kind of difficult for me to see, obviously, because everyone's on it's in the webinar. Usually, I do a lot of these presentations in person, but um, a lot of these businesses, are they all business owners? The people present?
Yeah, they're all business owners in different industries. A lot of them are in the coaching or the consulting space, right? They have
Okay,
a service, maybe it's business consulting, maybe it's marketing consulting,
right,
maybe it's health and wellness consulting, right?
right.
We also
So
have
they're
people
not,
that are in
yeah.
technology, right? They have like an app-based business or a technology-based business.
So these are not companies really that actually carry inventories and have to deal with the seller. They're
Some
selling
do.
service.
Some do.
Okay.
We have a few members. I know one's on the call that's getting into
Oh, kitchen
e-commerce.
retail. Yeah, kitchen.
Yeah.
Look, Jeff da Silva. Da Silva must be Brazilian, huh? Você é brasileiro.
Yeah. Why don't all of you put in like your industry that you're in? Just
Yeah,
pop
to
it in the
give
chat
us,
box to give them a little bit of an
yeah, throw it
idea.
in the chat box so we can see. We have one retailer so far. See, anybody else?
I know we have someone that
Oh,
that
health insurance, multimedia, media production agency.
there we
Oh,
go.
mold and water diamonds, real estate. Wow. Business owner, tech company with app for improving coaching and consulting. Very good.
There you
Yeah, so
go.
yeah, commercial real estate. Well, I have a real estate license since 95. Yeah, yeah, very good. Multimedia.
Multimedia.
Wow, incredible. Yeah, so again, when uh, when you have a consulting business, you're providing services. Oh, car detailing industry. Very good, very good. When you offer a consulting service, right? Sometimes you carry receivables, right? You may say, 50% up front and then 50% when the job is completed. So you're really carrying on your books a current asset, which is a
Right.
receivable.
Right.
Looking to open a smoothie shop. If that is the case, come to SPDC, my friend. Huh? An author. Oh wow, this is an interesting group. You
We
do
got
it,
a
Jaime. Come to us. Come to us. SBA loves acquisition loans, okay? And we'll tell you exactly what it is that they're looking for. And that way we can help to prepare you uh, for the approaching of a
and
of a lender.
Ray, I know that we have a allotted time till 1 p.m. on this. Is that correct? So
Yes,
want to
yes,
make
we
sure
do.
that we're on time here for you
Yeah,
getting what you need to share. And then I don't know if
yeah.
there's time for Q&A at the end too. So
Very
just
good. Okay, so
heads
let's
up on
move
that.
along. Yeah,
Yep.
let's move along to the next slide, which is okay. This is just a quick points about carrying receivables and basically to understand that receivables are a current asset, and as a current asset, you could use it as collateral, right? And there are a lot of banks out there that'll do receivable financing. Now move to the next slide because uh, The problem is that when they evaluate receivables, what they'll do is they'll look at, what your terms are, if you have any delinquency, and if you have any concentration risk, and all of that is carved out to get to a final amount, and then they usually will lend you 80% of that amount. Okay? Next slide. Next slide. Yeah. Okay. So without a quantitative analysis of all key areas of the business, banks cannot extend loan. So the recommendation is always, have good credit score, the level of indebtedness, and manageable, strong profitability and sustainable cash flows, because cash flows is what pays the bill. Remember, you can have a company with net income, as I mentioned earlier, but in reality does not have the cash flow. Next slide. So next C is collateral. What I always say, collateral is a secondary source of repayment. And I always told my students in college that collateral does not make a bad loan good, but a good loan better. Okay? Which, so lenders are not looking exclusively at collateral for repayment, They want to see some cash flow. Next slide. Now, there are benefits in having assets used as collateral in secured lending, particularly if you're a new company. Maybe you haven't been in business long enough, and usually, or if you have a low score, they may want some collateral, and then that way you can get the terms or rates are going to be, obviously higher, because the higher the risk, the higher the rate. Next slide. There you go. My favorite saying. Collateral does not make a loan good, but a good loan better. Okay. So again, bankers are more sensitive to cash flow. Oh, you have a digital marketing agency and holistics. Very good. Okay, next slide. Next slide. So the next C is condition, right? This is the fourth of five. It evaluates the industry of borrower's business and its external factors. Very important. Okay, they'll look at businesses, what kind of barriers of entries that they have, what's going on externally that's going to impact your business. Okay, that's why I always say, guys, you have to dedicate, some time to strategic thinking. You have to, stop for a minute. Don't be so hung up in your day to day and forget what's going on around you that can impact it. There could be regulation that's going to impact very negatively on your business, and as a result, it's going to be a problem. Okay, that in this area, does business need to be Florida based for a loan? Well, unless the lender is nationally based, buying into a painting franchise need capital. We'll talk. We'll talk. Okay, we got some interesting questions, right? So condition can also be the condition of the bank itself. There are some banks that don't have the let's say the skill set for construction lending, so they won't do it. So I always say, whoever you're dealing with in terms of a bank, make sure that you understand what their appetite is for lending, because you may be giving them all these deposits, which are the raw material for a bank, but in reality, your chances of getting a loan with the bank, may not be as good, right? Okay. So when you talk about condition, we look at the industry, and in the industry, we look at regulation, if there are difficulties and barriers of entry. Is it a maturing industry? These are all items that the lender will look at and to assess risk. Next slide. So capital is what? The skin in the game, right? I told you assets minus liabilities equals capital. That shows me just how much skin in the game. When I look at that capital structure and I see retained earnings, that tells me that you're putting money back into the business, right? But there are small businesses that spend all their money. Every year, at the end of the year, they write themselves a bonus and they don't put money back into the business. And that's a sure way of getting to negative capital and basically, reaching a level where you're not going to get a loan.
Hey Ray,
Okay.
if I can
Yes.
just jump in real quick. I see a few people raise their hands in the attendees list, Carson and Abigail and Serena. So I'm not sure if you had a specific question, but put your question in the chat box here
Yeah.
within the next 15 minutes, guys, and we'll have Ray answer that for you. So I'm not
You
sure
got
if
it. Yeah.
you raised your hand, but yeah, go ahead and do that. And sorry to jump in there, Ray, but just wanted to
No,
mention
no,
that.
no. Go right ahead. It's okay. Okay. Next slide, please. Next slide. Next slide. So this is just a simple calculation. How do you calculate capital? There it is. Asset minus liabilities, owner's equity, net worth, capital, all the same. Next slide. I always try to add a little bit of comic relief there, huh? Here's a guy that's getting a loan and his only asset are barrels. So I wouldn't want to be there when he takes that barrel off. Next slide. Go ahead. So to become bankable, understand what banks are looking for. Okay. You got to get that credit score at a reasonable level. That reasonable level is 680. Okay. You need a debt service coverage of 125 or above. All right. You need to, be cognizant of what constitutes, the efficiency in working capital cycle. Avoid too much inventory or too much credit sales, right? That's going to dry up your liquidity. Understand your performance margins, very important to understand. Are your margins deteriorating? Are there certain products that are a lot less profitable? Understanding from one year to the other where your margins are at is critical. Is critical and maintain an adequate level of capital through retained earnings. Put money back into the business, right? Or you're going to get you remember as a small business, you have two sources of funding. You have debt and you have equity. The thing with equity, a lot of people like to go through equity because they say it's less expensive, but in reality, what you're doing is giving away ownership, right? And so you're diluting your ownership of the business. So you have to reach a happy medium in that regard. Okay, next slide. Yes, what pays the bills? Yeah, sales are nice, but if the cash flow isn't there, where are you going to pay the bill? If you're selling too much on credit and you got your money tied up in inventory, where are you going to get the
Ray, I heard a great quote once that I love. It's revenue is for vanity, profits are for sanity.
That's right. That's right.
Revenue is for vanity, profits are for
Absolutely.
sanity.
I like it. I like it. I love it. I love it. Yeah. Yeah. Oh, it looks great on paper, but hey,
Right. But if you're not making any money, you make all this revenue, but you have costs that are higher, and no bueno.
no bueno at all. That's for sure. Okay, next slide. Next slide. I think we're moving along fine. Okay, this is again for those of you. I'm sure most of you are familiar with the term EBITDA, right? Earnings before interest, tax, depreciation, amortization. And this is the definition for cash flow, right? And how do you calculate net income plus taxes, interest expense, depreciation, amortization? Next slide. So we can have recommendation that's the other thing, keep your taxes up to date, and or at least for those of you, let's starting out this year, and you still haven't done your 24 taxes, at least make sure that your accountant prepares what we call interim statements, which is your balance sheet and your income statement, right? And that way, using that along with your previous tax returns is a good way for the lender to get started. Okay, next slide. And make sure you use some sort of accounting software, right? QuickBooks seems to be very popular. Next slide. And then, make sure I say 2 years. A lot of them ask you for 3 years, but some 2 years, and then the interim statements. Next slide. And this is my favorite saying: embrace and understand financial statements. Listen, you've got all these courses that we provide at no cost. Use them to better understand, improve your acumen about. You need to grasp the numbers and the financial aspects of your business. You can't forget that. And you don't want to fall into the hands of some Mickey Mouse accountant either. I hate to say that, but it happens. It happens. You need to, and listen, you also need to understand if you're trying to pay as little taxes as possible and say that you're not making any money, how do you expect to get a loan? If you come to me and you tell me you're not making any money. You see what I'm saying? So you need to keep a balance there, right? Next slide. It's an example of the balance sheet. I'm sure you guys are all familiar with. Next slide. The income statement. There it is. Next slide. And the famous cash flow statement I mentioned. Cash flow from operations. Huh? All right. So, and again, this slide on capital structure, it talks about the idea of really being able to, you need to manage your capital structure through a good management of your sources of funding, okay? Because remember, sometimes you need to go in, sometimes there are companies that I've dealt with that basically had too much short-term debt, and basically they owned an asset that had a lot of equity, and I've taken that asset, refinanced it, got them additional funds, they extinguished the short-term debt, and all of a sudden their cash flow improved significantly. Why? Because they had the ability to term out that debt at a longer period, and the subsequent result was the lowering of the monthly payment. So you gotta manage your capital structure. Next slide. And there's the balance between debt and equity. Next slide. I want to leave some chances. Here we go to the final recommendations, right? Keep track of your credit score and seek credit repair whenever needed. Take a course in financial statements and break-even analysis. You can do it here at SBDC at no cost. Learn to better manage your cash conversion cycle. Remember that, right? The shorter the term on that cycle, the more profitable you're going to be. Manage your debt responsibly. I'm sure you all understand that. And understand profit margins to better manage your profitability. Next slide. We're done. Okay, Joe.
All right. Well, thank you
Thank you
so
for
much.
that reminder. Now you've got
Yeah, we've
some
got
good
good
minutes.
7-10 minutes here to ask some questions. So if anyone has any questions at all, please type it in the chat box. We'd love to hear your questions or perspective. I'm wondering, Ray, if you can kind of go over some of the basics on applying for like an SBA loan and how that process works.
Okay, all right. So this is the way we do it, for example. And actually after this presentation, I have a call on with a lender. What I always do is number one, making sure that the client prepares a narrative, what it is that they want. In other words, I want a loan. Okay, what do you want the loan for, and what is the amount of the loan, right? Then a brief history about about the business. How long have you been in business? Okay, when I mean how long you've been in business means when you're reporting taxes, right? Don't tell me you've been in business the day you opened the company and you've only filed taxes last year, right? So
Mm-hmm.
they're going to look at that. The experience. These are questions that are going to be asked. So what I do is I prepare, a lot of the clients to understand what they need to come up with in that first meeting, right?
Right.
And then once we get a better feel, and I'll ask them for financial statements. I want to see your last 3 years tax returns, and like in this case right now, we begun a new year. And you haven't filed taxes. Give me your interim. Give me your interim statements, your balance sheet and incomes.
Right.
Tell me what your credit score is at right now to make sure so knowing what you want the loan for, the amount of the loan, a brief history of the background, your tax returns, give me a lowdown on your credit. I mean, is your credit to give me an idea if you're at the 680 level or not? And then we can start the conversation, right? I'll usually reach out to a preferred lender that we know that we've used before and use this narrative that I asked the client to prepare as an icebreaker and to
Right.
be able to get them to agree to a conversation. Then we'll have a Zoom meeting, and what will happen is the bank will run again through the gamut of questions. They want to know what the ownership of the company is. Are you a U.S. resident, a citizen? If you're not, you can't go the SBA route. They won't they won't do it. It's part of the
Okay.
standard operating procedures, right?
Right.
And then they'll ask the same questions that I would have asked. We would have provided that information, and then what they'll do is they will basically say, "Okay, we're interested. These are the documents that we need for you to send," and there'll
Okay.
be a list of the docs, which is pretty much, as I mentioned, the tax returns. They're going to provide you with an SPA 1919, which is a debt schedule to find out the debt. And then what they'll do is once they evaluate that information, kind of quickly, they will say, listen, we're interested in proceeding with this transaction. So what we're going to do, Joe, is we're going to send you a term sheet.
Okay.
And the term sheet is going to stipulate exactly what you're going to pay, what the monthly payments are going to be, the term of the loan, all of that. What's required in terms of equity on your part, right?
Right.
Yes, we
Right.
do. Zachary's
Makes
asking
sense.
if we provide advice for startups. Yes, we do. Yes, we do. So basically, in some cases, now that he mentioned the startup, it's very important that if you're a startup, that you have a business plan. You need to have a business plan because that's your blueprint. Because remember, you don't have a history, so you
And
need to
and
have a business
and
plan.
with that business plan, is it like like a investor deck? Is that okay, or does it have to be like a written out business
It could
plan?
be it sounds from the description of some of the members that you have. You have a lot of people that probably have a pitch deck, right? A
Yeah,
pitch
so
deck,
so Zach in particular, Zach's a member and he has the he's developing the app and the online software
right?
for corporate team building and corporate team engagement, right? So it's a startup. He
Right,
has a presentation deck.
right.
Yeah, so that's what he has.
Yeah. The business plan definitely is, yeah, to describe how the business plans to make money exactly, and it's going to give the history. It's going to provide an executive summary. It's going to touch on all the key areas because let's face it. Look, I always say dreamers dream and planners make dreams come true. You need a plan. You need a plan because that's your blueprint. If you're able to verbalize your ideas on paper in a succinct fashion, and obviously third parties are going to be interested, right? It's a lot easier. You can't come into a bank and say, oh, listen, I need a loan, and the guy says, how much and what for? No, I don't. What are you willing to give me? You can't do that. you
Right,
have
right,
to
right. Yeah,
you have to have a plan.
you have to
Yeah,
have preparation and plan. Makes sense. Yeah.
right. Okay, all right. Okay, Zach. Anytime, call me. What else? What else? Wow. Yeah. Let me see. Okay. Do
Uh,
we
Tax
see any?
consulting services. There's another question that came in from JJ Wolf. Do you provide tax consulting services or programs?
No, no. That's an area because remember that's a kind of a very sensitive area. We can't. In fact, even lenders cannot give you let's say tax advice. You need to go to a professional for that, basically. What we do, our advice is basically preparing you to, ultimately understand what you need to qualify to get a loan, right?
Right.
or if you need assistance in branding and marketing, or the continual growth. For example, I have a company last year we got a very large loan for. They recently won an award, a small business award, and now they're looking for they're looking for additional assistance, right? Hang on one
Got it.
second.
Yeah.
Craig, I'll be right with. Could you hang on? Could you give me 5 minutes? I'm finishing a presentation, but yeah, that's my other meeting. So anyway, yeah. So tax consulting, no, out of the question. You need to go to a CPA for that. Be careful who you choose, right?
And
Okay.
one last question, Ray. Thanks for the extra time here. This was great. In terms of like when you work with someone that's looking for a loan, you said you connect them to preferred lenders. Are you referring to like the SBA, the Small Business Administration loans, or do you have like, just regular commercial lenders that you work
No,
with?
no. Imagine. I've been in this business. There are people that I tap into that I've known for 30 years. So, I mean, SBA is popular with a lot of small businesses simply because they're government guaranteed loans. You have a lower down payment requirement. But no, I
Okay.
mean, if the company qualifies for a commercial loan, if we can make a determination that this particular company, has a good chance in going the conventional route,
Right.
or they just want to go, let's say, a commercial real estate. That yeah, we have lenders, and I know I have contacts that they're able to do that, right? So yeah.
Awesome. Another question from JJ. Are there any preferred CPAs in your network to that you can refer?
No, that's another thing. We can't make recommendations
Okay.
on unfortunately, maybe Alexis can provide you some update on that, but it's very difficult for us to make that recommendations in some areas, right? For example,
Okay.
legal and I think like accounting and legal, it's kind of like a taboo area, right? That
Okay.
that I guess the center doesn't want us to be stepping into that arena, right?
Into the
So that's
referrals. Got it. So it's just consulting.
yeah,
Um,
yeah,
got
yeah.
it. Okay. Well, Ray, thank you so much. I really appreciate you and Miami Made appreciates you. Hope you can check out one of our live events. They're a lot of fun. The first Tuesday of every month. Thrive
Very
Together
good.
Tuesday. Yep.
I'm gonna have to look you guys up.
Awesome.
Appreciate it. It's a pleasure, and again, we've got some other stuff that we can present in the future. Okay.
Yeah,
Amazing.
thank you all so much. We so appreciate your time. Before you leave, please take a moment here to take our survey. The way that we're able to do these wonderful workshops with partners like Joe is because we get your feedback. We want to know that what we're doing is helpful to you as entrepreneurs. Your time is precious and valuable to us. So we want to make sure that when you are spending it with us, it's things that can actually move you forward in your entrepreneurial journey. So the survey is about 2 to 3 minutes long. Please scan the code to take that and give us your feedback. And Lauren will also be putting it in the chat. And thank you all so much. Have a great afternoon. Thank you again, Joe. And thank you so much, Ray. As always, it was phenomenal.
God
Thank
bless.
you, Alexis. That was great. Thanks again, Ray. Take care,
Take care,
everybody.
buddy. All the best,
Bye.
man.
All right. Bye.